On April 3, 2025, the White House launched its biggest trade shock against Japan in over 3 decades, imposing a 25% tariff on imported cars and auto parts. In the blink of an eye, billions of dollars in market value from Toyota and Honda evaporated, and thousands of car dealerships across the U.S. went into a state of shock. Already tight car loan contracts now face the risk of higher interest rates. This isn't just a trade war, it's the early warning of a financial and geopolitical storm brewing right in the heart of the global economy. The Liberation Day tariffs that Trump rolled out weren't just a tax policy, they were a double punishment aimed squarely at major trade rivals. The first layer was a 10% tax on most imports, a broad stroke meant to apply pressure across the board. The second, more powerful blow, a 25% tax aimed at countries the White House deemed national security threats, with Japan topping the list. Kyoto News. On the surface, Washington claimed the goal was to save the U.S. auto industry, create jobs, and cut the trade deficit. But beneath this diplomatic veneer, it was a strategic move to force Japan to open up its markets to U.S. agriculture, technology, and services, which have faced trade barriers. The impact on Japan was devastating. Cars make up over 14% of Japan's total exports to the U.S., meaning this tariff hit the very heart of its economy, threatening hundreds of thousands of jobs in the supply chain and shaking the bilateral trade balance. Almost immediately after the 25% tariff on Japanese cars was announced, the negative impact was felt across the board, hitting the financial reports of the big players. Toyota, the global leader with more than 10% market share in the U.S., had to revise its profit forecast for the 2025 to 2026 fiscal year down to 1.4 trillion yen, about $9.5 billion, nearly 230 billion yen lower than its original plan. Operating profit dropped by 16% from 3.8 trillion yen to 3.2 trillion yen, dragging the profit margin from 10.6% down to under 9%. Net profit was expected to plunge by 44%, the sharpest decline for Toyota since 2008, directly impacting its plans to expand electric and hybrid car production in North America. Honda took a similar hit but faced a faster drop in profits. In Q2, profits plunged by 50% down to 196.7 billion yen, around $1.3 billion, compared to 394 billion yen in the same period the previous year. For the full year, Honda expected to lose around 450 billion yen, approximately $3 billion, nearly 15% of its market capitalization evaporating in just 6 months. Notably, more than half of this loss was directly from tariff costs, with the remainder coming from losses in its electric vehicle segment in the U.S. This impact wasn't limited to just these two companies. According to the Wall Street Journal, within a few months of the tariff imposition, the total losses for the global automotive industry had reached nearly $12 billion. This amount reflects the cumulative cost of tariffs, supply chain disruptions, especially with parts imported from Asia, and fluctuating exchange rates raising production costs. European and South Korean automakers also faced higher costs, with some considering reducing production or relocating factories to avoid the tariff blow. These numbers show that this wasn't just a protectionist trade policy, it was in reality a financial and strategic shock, forcing companies to rethink their global strategies if they wanted to survive in this new tariff environment. Japan is currently the largest foreign creditor of the U.S., holding around $1.13 trillion in U.S. Treasury bonds, over 12% of the total foreign-held U.S. debt. This figure isn't just a reflection of the deep financial ties between the two economies. It's a strategic lever powerful enough to shake the U.S. financial system if deployed. On May 2, 2025, Japan's finance minister publicly stated that this holding was a bargaining chip in trade talks with Washington. If Tokyo were to sell just 5% of these bonds, about $56 billion, the U.S. Treasury market would immediately be drained of liquidity, pushing the 10-year Treasury yield up by 45 basis points. This would raise mortgage rates in the U.S. from an average of 4.5% to nearly 5%. The effects wouldn't stop at real estate. Business loans, car loans, and credit card interest rates would rise as well, creating a double burden on domestic consumption and investment. The tariff blow and financial disruptions didn't just hit the boardrooms of CEOs or trading floors, they went straight into the lives of millions of Americans. First, auto workers face the risk of widespread job losses. Labor organizations estimate that over 500,000 jobs in the auto industry, including assembly, parts manufacturing, logistics, and maintenance, could be threatened if sales drop sharply. States like Michigan, Ohio, and Kentucky face particularly high risks due to being production hubs for Toyota and Honda. In Kentucky alone, Toyota's Georgetown plant employs over 8,000 direct workers, with tens of thousands more in the local supply chain. A reduction in production or the shutdown of the plant could create a domino effect, impacting the entire ecosystem of jobs around the factory. Second, new car buyers are paying a higher price than ever before. With a 25% tariff, the price of imported cars from Japan increases by $2,000, $4,000 per vehicle. A typical sedan like the Toyota Camry or Honda Accord, which previously started at $28,000, $30,000, could now exceed $32,000. Moreover, car loan interest rates are rising along with broader market interest rates, adding thousands of dollars to the total cost of car ownership over the life of the loan. As a result, many consumers are delaying or canceling plans to buy new cars, directly pulling down sales and creating a negative cycle for the industry. Third, home buyers are also caught in this financial whirlpool. If U.S. Treasury yields rise by 0.3 to 0.45%, a likely scenario if Japan adjusts its bond holdings, mortgage rates will follow suit. On a $300,000 mortgage, borrowers will pay an additional $500, $700 per year just in interest, not including insurance, property taxes, or maintenance costs. In more expensive markets like California or New York, this increase could exceed $1,000 per year. Fourth, declining disposable income is becoming a central issue. As car loan, mortgage, and goods prices all rise, the remaining budget for other needs, food, clothing, education, entertainment, will shrink significantly. This tightening is putting pressure on retail, food service, and small businesses that rely on household spending. Economists warn that this could be a double hit. It would slow domestic consumption while also dragging down national GDP growth. In other words, this blow isn't just hitting the car market. It's directly impacting Americans' wallet and job stability. The news of the tariffs and Japan's bond card immediately sent the U.S. bond market into a tailspin. In early April 2025, the 10-year Treasury yield spiked by over 70 basis points in just 1 week, the biggest jump since 2001. This shock created a chain reaction. The yen strengthened, making U.S. goods more expensive in Japan, reducing competitiveness and choking off U.S. exports. Meanwhile, emerging markets panicked over the potential for capital outflows and volatile exchange rates as international investors flocked to safer havens. Domestically, consumer loan rates and business borrowing costs rose, pushing up the cost of capital and forcing many expansion projects and new investments to be postponed. In short, just a hint from Tokyo was enough to shake the U.S. financial markets, sending shockwaves across the globe. The U.S.-Japan tariff war has gone beyond the realm of trade, evolving into a game of financial and geopolitical chess. Japan hasn't sold any bonds yet. Just a hint of doing so was enough to get the U.S. to reconsider the tariff. But if tensions escalate, the double shock of tariffs and financial pressure could very well rock the global economy. The question remains, will Washington continue to tighten the screws to force Tokyo into further concessions, or will it step back to protect financial stability? And will Japan ever pull out its $1.13 trillion bond card, or will it remain just a psychological weapon in this high-stakes standoff?